Welcome back, everybody. In this video, we're actually going to talk about something a little bit different here. How much cash should you be holding on to when interest rates are going up? And we're going to listen to one of the greatest investors kind of break this down, and then we're going to simplify it to how it could apply to you. So let's get into it.
Historical ratios, right?
Well, you've got to crank in interest rates because everything in valuation gets back to interest rates. And if you take the U.S. Treasury bill now, which is we'll call it 80 basis points, depends what maturity. That means the U.S. Treasury bill is selling at 125 times earnings. Now, if your alternative is to buy something at 125 times earnings, or a good business whose earnings will probably increase at 15 or 18 times earnings, you've got to measure it against the risk. It isn't really a risk-free instrument, but the standard rate. And in 1982, the rates got up 15% or thereabouts, and that makes a lot of difference. I mean, you've got a choice with money. What do you do with it?
By the way, if you're new to the channel, welcome in. We take a logical approach to investing on this channel and line up the macros with what opportunities could be into individual stocks. But today, I want to focus on the stock market versus yields right now. So as inflation is coming down and the market is going up, we have an interesting dilemma that's taking place here. How much cash should you personally be holding on to at these types of levels? And we're going to let math basically do most of the work today. So we have 1-year treasury sitting over 5%, which hasn't been seen in nearly 20 years. And we have 3-month treasury sitting right around 5.4%. And this is a big reason why Buffett is sitting on the sidelines. In this older interview, Buffett states that interest rates were sitting at 80 basis points, and he comes up with an equation with over 125 times earnings versus an S&P that's probably trading in the 20s. So therefore, the S&P or stocks itself were cheaper than yields. How did he come up with this, and how does this work for you? So if we take 100 divided by 0.8, which is 80 basis points, we get right around 125 times earnings for an 80 basis points yield. But when we get 100 divided by 5.4%, call it, we basically get 18.5 times earnings, which now begs the question of, when we think about a risk versus reward, a huge reason why Buffett is sitting on the sidelines here is, number one, he can earn risk-free yield at basically comparable rates of 18 times earnings versus an S&P 500 sitting at 26.3 times earnings. So if we take our emotions out of the equation and we look at the index as a whole versus where yields are standing, and we talk about risk being a factor here, meaning that markets could go down 10, 15, 20, 30, even 40% on any given month or year, we have to put some more weight on the fact that cash is actually a little bit more valuable now from a valuation standpoint. So when we look at 5.4% and we take a look at where the S&P 500 is trading, we can see here you're getting a substantial amount of return for pretty much no risk with where yields are sitting currently. And the powerful thing about this is that you're earning 5.4% risk-free, and then you now have the opportunity to now buy an index that may get to a more competitive or compelling valuation. Meaning that if the S&P 500 got closer to 20 times earnings, then you can take some of that money and possibly dollar cost average into the S&P 500 because you are a little bit more overweight cash, because you let math solve this problem and not emotion. What we're starting to realize here in this market currently is that earnings growth is going to be sitting right around 4 to 5%, but yet we've watched an S&P 500 basically go from 19 times earnings all the way up to 26 times earnings, which means that this is all about multiple expansion and not truly earnings growth. Yes, earnings weren't as bad as everybody anticipated, but the problem is the price is getting too expensive. When we look at the P side of the equation, that's the only thing really going up. If I were to tell you, I'm going to give you a 4% rate of return, but I'm going to charge you a 40% premium for that, would you be taking that opportunity? And that's why Buffett is not taking that opportunity. That's why he keeps being a net seller of stocks and going into 5.4% treasuries. The other reason why he's doing that is he understands that when markets get inflated to this level, and we look at debt to GDP, and we look at the Buffett indicator, and if we just look at historical valuations of the market and indexes overall, we're in the upper decile when it comes to that type of valuations currently. And he understands that having cash at 5.4% allows him to keep building more and more cash risk-free, but also get into an interesting standpoint when there's a liquidity crunch or people are going under. He can make very, very great deals and be on top once again. And so the reason why Buffett is sitting back is he's basically breaking down that cash right now is actually a little bit more attractive than the stock market. Now, for you personally, depending on your time horizon and how your portfolio is diversified, everybody's going to be a little bit different here. Comparing PE multiples, and we say that you can either pay 26 times to go in the indexes, or you can get 18.5 times on a risk-free basis. The 18.5 times is very, very appealing because at some point in time, there is going to be a substantial pullback because valuations do eventually matter. It's just a matter of when. And when that pullback happens, we can get very big disconnections, which allows us to really get a good dollar cost average. Now, of course, how I would do this is if it was an apples to apples comparison, meaning if the S&P was trading at 20 times earnings and we were sitting closer to 5% on risk-free, I would have basically an 85 to 15% ratio, meaning 15% of my money would probably be in cash, 85 would be in the indexes. But as that starts to get more dysfunctional, I definitely would be leaning more heavy on the cash side because valuations do seem to be stretched when we compare them to a relative yield perspective. As always, this was just my opinion. Hopefully you enjoyed, and we will see you in the next one.